Dear valued investors, November is often a time to reflect and offer thanks. And while economic and geopolitical uncertainty can overshadow the positives, there are things to be thankful for. But before we look forward to Thanksgiving, let's look back at the last month and review the volatility felt by investors. For much of October and most of the recent 2 weeks, stocks were weak and often showed the negative sentiment in even weaker late-day trading as we moved through the month. However, this sentiment has shifted over the past few trading sessions as the month ended and November began. Stocks showed strength as markets were ending each trading day. Therefore, we analyze whether the selling is exhausted and if a late-year rally could be in the cards. Since the year began, historical trends took fold, and 2023 has been one that followed in lockstep. Seasonality in September and October, which we historically viewed as the most volatile months, did not disappoint. However, recently we have observed a strong move downward in the volatility index, pointing to lower volatility in the near term. We also see a Federal Reserve slowly shifting language in their communications, pointing to lower future inflation expectations. Their efforts in 2022 and 2023 are felt throughout most areas of the economy as they fought rising prices. Here's just some of what we are thankful for now that we are coming down the home stretch of 2023. Number one, the resilient U.S. economy. Coming into 2023, the dreaded R word, recession, seemed a near certainty, but the most recent data showed our economy grew at a strong 4.9% annualized clip during the third quarter, the fastest rate since the initial COVID-19 recovery. Even though borrowing costs are rising, the consumer remains in good shape, bolstered by a strong job market and rising wages. While the economy is likely to slow in coming quarters, it is unlikely to slow enough to concern all stock market participants, given the health of the consumer and corporate America. We're also thankful for the end of the earnings recession. Solid third quarter earnings versus expectations mean the earnings recession is almost certainly over. The market's reaction to the results has been mixed at best amid all of the uncertainty, but a 5% year-over-year increase in S&P 500 earnings is a distinct possibility, perhaps even higher if we're excluding the energy sector. We're also thankful for easing inflationary pressures. Surging inflation and the Federal Reserve's aggressive response were the biggest stories of 2022 and most of 2023. But it seems inflation has eased enough to keep the Fed on hold at its next couple meetings and potentially move in the other direction of cutting rates in 2024. Historically, stock and bond markets have tended to perform well after rate hiking campaigns. We're also thankful for fixed income is now an attractive asset class again, despite the recent bond bumpiness. And after nearly a decade of very modest returns, yields for many fixed income investments are the highest they have been since 2007. Starting yields are the best predictors of future long-term returns. So at these higher yield levels, fixed income returns may be higher too. Moreover, the yields for some of the highest quality fixed income sectors are offering attractive income again, which reduces the need dramatically to invest in low quality bonds to generate income. There's no doubt this year has been challenging, given the increased economic and geopolitical uncertainty. But taking a balanced view on the economy and the markets, we believe there are some positives that may help stocks finish the year higher. Even in the face of potential volatility, focusing on long-term goals while tuning out the short-term noise continues to be highly recommended. Please reach out to me if you have any questions. Stay safe and stay the course.